Okay, it is 11 o'clock. We can get going. So thank you very much for tuning in on a nice sunny summer morning. And I've got a bit of stuff to do before we get to Craig, but we're going to be talking to Craig Martin from Vietnam Holding in a minute. As usual, a bit of news first. So things I pulled out there on the screen. The first of which is the decision that Fidelity has taken to choose AVI Japan Opportunity as its merger partner. Now, when I put these two graphs up, it's really obvious why. This is the graph of Fidelity Japan over the last 5 years, not very good. And here is the equivalent graph for AVI Japan Opportunity. You can see the difference is remarkable. And also, thing to note in there is how well AVI Japan Opportunity has been trading normally. So it normally trades very close to asset value, which is obviously very good news if you're thinking about rolling over. Now, the way that this has happened, this has been announced as the conclusion of the strategic review that kicked off in anticipation of the failure of the continuation vote. So they actually launched that knowing that they're probably going to lose that vote. The way this is going to work, it's a normal kind of Section 110 scheme. So Fidelity Japan will end up getting liquidated and the assets rolled into AVI Japan Opportunity. And it helps that there's a big swell of shareholders from Fidelity Japan in favour of doing this. So AVI Japan said that City of London has said it's in support. It's 23% of Fidelity Japan. And Fidelity Japan said holders of its 50% of its shares want this to happen. But there's no thing in the Fidelity statement to say that the board's kind of recommending this or is happy to announce, or there's nothing at all. They've sort of been dragged to this kicking and screaming by their shareholders, and it's kind of sad in a way that they haven't been listening to the shareholders beforehand. And I don't really understand why they're so anti it, but I don't think you should take that as any reason not to go ahead with this. In fact, I think this is probably quite a good deal. So they're offering a 50% cash exit as an option, and if you go down this route, you'll get out as a 1% discount to the formula asset value, and obviously the formula asset value includes the costs of doing the deal, or at least Fidelity's side of the cost of doing the deal. And we don't know what they are yet. Or you can switch into AVI Japan, and if you still want out, there's a 100% exit opportunity later on this year, probably in November, and probably at a 2% discount to the formula asset value again then. And the costs associated with doing that are going to be a lot lower than the costs associated with doing this transaction. So whether you end up with more money or not is up for debate, but it's possible. And also, in any case, I think you should probably want to hang on. I mean, there'll be some discount players in Fidelity that will just want to roll all their money into something else. But I think if you want to keep your money in Japan, this is the ideal way to do it. And you've always got this option, because this is an annual exit opportunity in AJOT of saying, actually, I want my cash back now. And they're also going to try and keep it trading close to asset value. So they've got a sort of policy of trying to keep it within a sort of 5% discount using buybacks. So for all of those reasons, I'd be more inclined to roll into AJOT than take the cash exit option, but it's up to them, obviously. In terms of the AJOT shareholders, they're not disadvantaged by all of this. Basically, to the extent that there's an uplift that comes with the fact that the Fidelity Japan people are getting out a discount, so that actually benefits all shareholders going forward, and that some of those are obviously AJOT ones, and so that offsets some of the costs. But to the extent that that doesn't offset the costs, AVI is going to top the money up so that there is no disadvantage here. We do know that Fidelity Japan's costs are estimated at 800 grand for the fixed stuff, but that doesn't cover everything. One little wrinkle in all of this is that Fidelity's got some unquoted. They're not a huge chunk of its portfolio. And AVI said it's going to be less than 5% of the combined vehicle. I think it should be, on the maths, a bit less than 5%, actually, maybe sort of 4%. But regardless, it's not a huge chunk, but it is something different from what AVI has been doing before, and I'd expect those to be sort of managed out over time. Actually, Fidelity just sold one of those at a premium to book. Part of the sweetener for getting this deal done is that the AVI Japan is going to cut its fees. Well, in fact, they're just going to introduce a tiered mechanism. So effectively, there is no immediate fall because the assets are less than 300 million. But we do like these tiered fee structures, and they are good news. And even assuming the 50% cash out, we will get into those next couple of tiers, I think. Obviously, you're also going to end up in a much larger, more liquid vehicle. So tick, tick, tick. I think this is a good thing to do. And crucially, because we're always worried in these situations, am I getting out of an investment strategy that hasn't been working for a long time to go into one that has been working for a long time and switching horses at the wrong time? I still think this Japan corporate governance thing has got an awful long way to go, and AVI, if you read our notes, has got no shortage of things that it thinks it can make money out of. So I think there is more to go for. On the property side of things, just to wrap these up, otherwise I would have got Richard involved, but basically we've talked about these things before. Unite is bidding for Empiric student property rather. And the board of Empiric's now recommended this. The deal is 0.085 new Unite shares and 32p in cash for every Empiric share. The problem is, as you can see from this chart, that the Unite share price has been drifting off, and that is not helpful. So here is a handy table to show you what that all means. So based on the price last night, £7.35, the Unite share price was £7.35, and the value to an ESP shareholder of that is 94.5p, more or less. When the deal was first announced, was 5th of June, it was £8.37, and that would have been 103p. When Unite first approached Empiric, it was 7th of May, it was 856.5. And if you go back to Unite's last high, which is September 21, then that would work out at £1.36. Now, I'm a shareholder in Empiric. I am inclined to take this and then hang on to my Unite shares and wait for a better price. I think because of the size of the companies involved, there probably has been some merger arbitrage going on here. It doesn't happen every time. I'm not sure it will happen with the AVI Fidelity one because the things aren't huge. But nevertheless, I think the Unite share price has been going down because our merger arbitrage people have been selling it. That's one of the things I suspect. So I'm going to hold on and wait for recovery. The other one that got wrapped up this week was PHP's bid for Assura. So that went unconditional on the 12th. At that time, they had almost 63% of Assura shares in the bag. When it goes unconditional, there's still time for you to accept the offer if you haven't done it already. So they leave 2 weeks open to do that. But for those that had already ticked the box, you're already going to get switched into PHP shares. So they listed on the 14th of August, which is yesterday. And the cash part of the bid should hit bank accounts around the 26th of August. PHP will delist Assura once it has 75%. I think that's likely to happen fairly soon. It hasn't happened yet. So unless you want to end up in a delisted vehicle, I would say tick the acceptance box. And you always get this situation where if they get to 90, they can force you out anyway. So it's just whether you end up in this sort of limbo land between 75 and 90 where you're stuck in an unlisted vehicle, which isn't a great thing to do. Now, the last thing from me that I wanted to mention was third-party investors. Now, we've talked about this a fair bit, as I've explained before. I think that spike in the NAV back in end of 2024 is a mistake by Morningstar, but that's by the by. But you can see the discount is wide there and stayed wide and actually got wider more recently. Not very good, 24.5%. But nevertheless, as I sort of said it might happen, they have won the vote to approve this idea that they're going to buy a life insurance company and effectively reverse the company into that. So they're going to take money out of the master fund that's been doing hedge fundy type stuff and invest it in this Malibu life business instead, which is a major switch of policy. And normally you'd expect to be offered an exit at NAV in this kind of situation, and the fact that you haven't been is totally wrong in my view, and that's a failing of the Third Point board. But when it comes to the votes here, they have been skewed by something called VoteCo, and I'm trying to explain what's going on here. So this is how the votes would have gone had the manager not voted, because obviously he's conflicted, but he still, for whatever reason, was allowed to vote. I think that's wrong. And had VoteCo not voted. So had that been the case, many of these resolutions would not have passed. And that to me suggests that this thing would not have happened. So the vast majority of minority investors do not want this to happen. And that implies by number of shareholders as well as by the votes that they've got. VoteCo was set up from the beginning. It was in the 2007 prospectus, and it's done because Third Point would have run into trouble had it ended up being controlled by American investors. That's just a regulatory thing in the States. It would have come with all different sorts of rules and regulations, and they didn't want to be in that situation. So they created a scenario where they set up this VoteCo thing that holds B shares. The B shares have voting rights but no economic interest. So all they're there is to do is to vote. And they're supposed to have no affiliation with the manager or the underlying master fund. And they're supposed to vote taking into account the best interests of shareholders. Now, remembering that the vast majority of minority shareholders here feel that they have been disadvantaged and do not like this idea. This is not great that they have voted with the manager, and also, as we'll see here, they refuse to actually talk to the minority investors beforehand, which I just think is mind-boggling, really. They could have abstained. I think if they didn't know what to do, they should have abstained, and that wouldn't have been a dereliction of their duty. But they just refused to talk with minority investors and then voted with the manager. And that's not the first time they've done it, because there was an attempt to remove. There was a director appointed by the manager on the Third Point board, and disgruntled shareholders tried to remove him before, and VoteCo again blocked that. And also, it's been pointed out that these directors have been there. Two of the three have been there since the beginning, which is obviously against good corporate governance anyway. So there's a suggestion by the investor group of the minority investors that we've got together to try and block this. That given that these people have sort of fallen down on their duty to investors, you should maybe not think about them in terms of being director or anything else. And so there's a list of them there and what the boards that they're involved in at the moment. And to be honest, I have a lot of sympathy for that view. I think this is all a bit dreadful. So if you want out now, you have still got this cash exit option that they did improve a bit. It's still not great. It only gets out of less than a quarter of the fund, and at a quite a big discount to NAV. Then you're going to have to sell the rest in the market, taking a loss. And obviously, if all these people try and do that at the same time, there is going to be a pressure on the discount again. But I don't think, in all consciousness, I'd recommend going into a life fund or a life insurance company like this Malibu thing is going to be. The minority investors have described this as a kind of vanity project by the manager, and it's hard to disagree with that. So that's enough from me.